Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's Bull versus Bear webinar. Steve Miley on the call here for Trade Day on Thursday, the 6th of July. Welcome, everyone. Welcome. So we're going to go for our usual regular run through in here today. Take a look at the calendar, what we've had, what we've got coming up. Going to take a look at the articles from the major news sites, news wires. What are those macroeconomic, fundamental, geopolitical, central bank data events that are impacting financial markets right here, right now? And then once we've run through those, we'll take a very quick look at the chart, see where I see any kind of potential trigger points, where are the bias running into today. But I know you guys are trading, most of you, very short-term time horizons, so not necessarily. It's pretty difficult to do any kind of real technical analysis because we've got people trading on, 1 minute charts, on tick charts. We've got people trading all different styles on longer term charts. Some people holding positions for the whole day, some holding for literally 30 seconds. So, I'll do what I can. Good morning, Richard. So, let's go. Let's run through. First of all, I just want to highlight, we do put this in here every day. I put this up. These are technical analysis reports I write. Now, bear in mind, again, having said what I just said, these are written for my institutional clients. I'm still a technical analyst. I still write reports for my institutional client base. So these are like aiming more at kind of like swing traders, day traders, sort of like position traders within banks, bank market makers, that kind of stuff. So this is a little bit probably longer term than maybe some of you are trading, but nevertheless, I think it's still useful. So it's not aimed directly at you guys, but it gives you the important trigger points. So I just wanted to, just highlight this. This is available in the trading room every day. I put it up actually every night. I put it up around the close. It goes up pretty much right on the close. So that's available. Still hanging on to a bullish theme in here for both the major stock indices, even though we're dipping a little bit in here today. And on gold, so we can basically do it on S&P and NASDAQ. Gold still looking negative for me. And then oil in here currently looking for the upside. So just to give you a little heads up on that. Let's look at the calendar, what we've got coming up. We're looking back to yesterday. Really, well, even though it was really all about the minutes, the market kind of sold off. And even though this durable goods orders were like kind of pretty much in line with expectation, factory orders was very much below expectation. That was a real disappointment. Well, that was one of the drivers. We're already on a negative footing in the morning with European and Asian stocks down yesterday, having come back from the US Independence Day holiday on Wednesday. So we were on a negative footing with Europe and Asia down. And then the factory orders number didn't help either, showing potential slowdown in the economy. So concerns there. And then really the markets didn't move too much post the Fed meeting minutes, but the Fed meeting minutes, I'll come and talk about those. You've got some articles on that. But you would have to say they were more on the hawkish side. Yes, they agreed to the pause, but a lot of members wanted to hike as well, but they agreed to pause. Everyone pretty much agreed that they're going to have to hike again. We know that that's priced in for July and maybe multiple hikes going into the end of the year, which the market's not really pricing in. So we'll take a look at that. We'll have a look at the slightly updated Fed tool in here and how that's reacted to that. We also had Williams on the tape. I'll come to Williams shortly. We've got a little article to pop out on that. This morning in Europe, we have had some factory orders numbers out of Germany. That was much better than expected compared to like the US data yesterday. And then we had this construction data in line. And then in the UK this morning, we've had the construction PMI. Construction, quite a big part of the UK economy, housing. And the economy, so the number worse than expected from the UK. The FTSE 100, that's the UK stock index, top 100 stocks in the UK London Stock Exchange, is actually sitting at 3-month low, and I got a little article on that. EU retail sales are really more the standout data of the day in here, and again missing expectations, so negative in here. So overall, kind of a negative tone also out of Europe in here this morning. Looking ahead to today, in just 40 minutes time, we get the ADP non-farm employment change. Remember, this is the precursor, the pre-runner, like the heads up kind of the private number compared to sort of trying to almost pre-forecast what the actual US employment report is, what we get on Wednesday. Now, normally this ADP employment number comes out on the Wednesday before the employment report, which is tomorrow. Incidentally, we had 17, I'll repeat that, 17 traders failed the evaluation challenge yesterday because they were trading over the Fed minutes. Please don't trade over the Fed minutes. You will be fouled if you go over the Fed minutes. We're not doing this to make money. I mean, I couldn't have, I mentioned it on the webinar yesterday. I put it in 2 different forums yesterday. I put it in the heads up and we emailed it out yesterday to everyone, right? We're not trying to make money out of this. We need to protect our own capital when you go live. None, 0 of our funded traders had open positions over the Fed minutes, okay? They're showing the discipline. They know the rules. They know what they're supposed to do. If you don't know what you're supposed to do, then you shouldn't be trading in risking initially your own money, right? And then risking my money on our money, Trade Day's money, when it comes to you going live. So we want people to know what they're doing. We don't want them holding positions over these major events where we can have, in the real market, you could get massive slippage and we could just, lose potentially, a lot of cash. And this is standard. This happens in prop firms. We're not being mean. We're not trying to not allow you guys to trade, right? It's literally 4 minutes, okay? And the 2 data events occur once a month. So it's 8 minutes once a month. And then the 2 Fed events, okay, so it's US employment tomorrow and CPI, okay, those are the only 2 data events. That's 2 4-minute windows in the whole trading month, okay? And then we have 2 Fed events, and the Fed meetings are approximately every 6 weeks, okay? So you have 2 Fed events every 6 weeks, okay? That is it, right? And that's another 8 minutes, 2 4-minute windows. That's it, right? That's all you need to know. And to be quite frank, even though I know all of you guys are technical traders pretty much, right? You're pretty much technical traders. I'm a technical analyst, right? I've known since I was a kid. I don't live in the US, right? I've known since I was very young, since I was into markets at 17, 18, what the US employment report was, what the US inflation. I knew what the Fed is. I knew when the Fed reports were coming out, right? It's not difficult stuff, right? If you want to be in this game, if you want to be a prop trader, if you want to make the living out of this, right? I know this sounds like it is a lecture. It just frustrates me. It just really, 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 really frustrates me that we have to foul people and it's costing them money, right, to make them more disciplined, right? And that's the only way that people will be disciplined, right? So sorry for the big lecture, because I know probably nearly all you guys who are listening understand this rule and appreciate the rule. It's not there, and people think it's there for us to make money. I don't need that money, right? We don't need that, right? I'd rather not be doing that. It takes up a load of our time as well to risk manage all of that, right? I'd rather not be doing it. I'd rather people just stuck to the rules. Anyway, there you go. Enough lectures over. So we do get the ADP. I'm getting back to where I am now. The ADP employment change. So we get that. That's the precursor. Where is it in here? ADP employment change. That's only in 36 minutes now. That's the precursor to remember to tomorrow's payroll, which you can't have a position over. Okay, 2 minutes before, 2 minutes after. No working orders either. 228, okay, is the expectation for the ADP non-farm employment change coming up in 36 minutes. Then after that, the focus is going to switch here to the service sector PMI, right? So this is from S&P Global. Now, even though this is important, it's not deemed as important. Remember, we've already had the flash data in here. We had that at the end of June, okay, last week. We had the flash data for this already. So usually this is not too much out of line. We get that at 9:45 Eastern, okay, 9:45 even. The S&P Global composite PMI and the service sector PMI. Again, because we've had the flash PMI, these numbers then revised from the flash PMI data, and we only get about another 20% of respondents. So it doesn't usually move too much. So this one won't probably too much out of line. However, we have not seen any of this data in here. The ISM, non-manufacturing, which equals the service sector PMI data. Okay, that is the key one there at 10 o'clock Eastern, expected at 51.0. Okay, that's the key one we're going to be watching this afternoon. If you're trading oil, remember no trading oil over crude oil inventories either. We've got that coming up today. And then I don't think we've got any Fed speakers today, have we? No Fed speakers today that I'm aware of. Okay, so that's the big focus though on this. And then obviously tomorrow we've got the employment report. So this is important though. The ISM data, the 10 o'clock data is the bigger focus, but we also get, as I say, ADP. Non-farm employment change expected at 288 in 35 minutes time. Right, let's run through the articles from the major news. I'm going to start off with 5 things to start your day. If you don't know already, I mean, you haven't done this for a while in here, but if you go to Bloomberg, now you have to subscribe to most Bloomberg articles. I have a subscription, so I can share these with you. But if you want, you can go over here on the front page, bloomberg.com/markets. I'm putting it into the chat now. It's in the chat. Over here on the right-hand side, enter your email. You get 5 things to start start your day into your inbox if you don't have it already. It's a free resource. Why not have it, right? You can also access it for free if you go and find it on the site. So 5 things to start your day. Hawkish pulls. I'm going to talk a little bit about that as we go through. Actually, I'll talk about it now. So the Fed was certainly more hawkish in their tone, certainly looking for more rate hikes. I've already said that, certainly looking for at least one more this year, potentially two this year, maybe more this year. So certainly a fairly hawkish tone in here on the current pools that we're in. Janet Yellen has arrived in China. This is on the back of, we said 3 weeks ago, Blinken was there, okay, trying to build ties and aiming to find common ground. Seems to be a little bit of olive branch coming from both ways. And President Xi of China in here earlier on in the week talking about globalization, talking about and not being not isolating, talking about keeping supply chains alive. So that sounds like a positive. Meta have launched Threads, which is their rival to Twitter, and that's launched. I saw 10 million signups in the first 7 hours. There you go, 10 million signups in the first 7 hours. Still way off Twitter's 300 million, but still that's a lot of sign-ups. Let's see how it does, and we'll be seeing. I have signed up, and we'll no doubt have the trade day thread launched very shortly. So what else have we got in here? Market drops. Yeah, so market's a little lower in here this morning. They're getting pulled down by higher yields, really, and that's on the back of this, really, on the back of the hawkish pulls. So the hawkish data, bond markets were already selling off to lower prices, higher yields. That was already happening on the data that we had yesterday. We'd already seen the move on the data from yesterday on that the factory orders data, the durable goods data and factory orders data in here. I'd already sent the market lower, and we were lower anyway, right? So we were lower. Sorry, that was lower in bond prices, higher in bond yields. But then the Fed reinforced that. So we've gone, and then that's weighing on the broader market and particularly on tech. Remember, higher yields, higher interest rates impacts more on the Nasdaq because it's full of growth stocks, and growth stocks are more sensitive to higher interest rates. Oh, Logan speaking this morning as well. Okay, thanks for the heads up on Greg. Greg didn't see that. Don't think it's in here. Yeah, missed it. Oh, that's yesterday. Today. Yeah, not on. Oh, it is. Well done. Sorry, missed that. Yeah, skipping through to it. Yeah, Logan speaking 8:45 Eastern. So watching out for that one as well. What else do I have for you? So this morning we've had this Eurozone retail sales flat in May, but that was worse than expected. We looked at that already. Still down year on year. So that was a negative, dragging European stocks lower. Fed Williams says data supports more action. So Fed Williams, and now if we go and take a look, do you remember in here at tradeday.com, you can go and get this access from the members area in our trading advice in here, and we go and take a look at, I think it comes under news, it's not under advice, and it's a little way down. We've got the Hawk Dove sheet. I think it's on the second page in here now. Need to maybe try and pin this one because where's this one? News. Maybe it was on the previous page. Let me just get it. We got the Hawk Dove sheet on here. There it is, Hawk and Dove sheet. Okay, so on the Hawk Dove sheet in here, we can see where the various speakers. So we spoke just there. We've got Logan speaking. Logan up here, more of a dove at the upper end in here, but and Williams also slightly more on the dovish side. So it's a dove saying something that's fairly hawkish, right? Data supports more action and interest. New York Fed chief says step will depend on economic data. Officials get jobs officials before the July meeting. Yes, we're getting obviously got the July meeting not till the end of the month in here, and we've got obviously the jobs report coming up tomorrow, and then we also get the inflation report, which I don't think it's next week. I think it's the week after. What else do I have for you? Fed minutes reveal divisions over decision the pause in June. So some wanted to hike, right? So even though we paused, there were dissenters. Some wanted to hike. Global stock sliders traders better more hikes. So UK 10-year yields rise to the highest since the crisis that we had under Liz Truss last year. US futures fall in here. ExxonMobil on weak outlook down on that. Stock sliders rising borrowing costs again in here. Looking at the negative side of potentially higher rates hanging on stock. Wall Street's post modest loss after Fed minutes in here. That was last night. Wall Street futures slide on rate hike jitters, but Meta up on that announcement and the launch of threads. What else do we have in here? Instagram reveals threads. We already mentioned that. And Yellen in China. Both sides locked in confrontation, and again, Yellen arrives in Beijing for economic talks amidst tensions. Just incidentally, Bitcoin has hit a 13-month high. Bitcoin has kind of been positively aligned with risk assets. So Bitcoin hitting a new 13-month high, potentially a positive, highlighting underlying support for riskier assets and maybe stocks. But on the flip side, the UK FTSE, the UK FTSE 100, that's the UK benchmark stock index, the top 100 stocks in the London Stock Exchange. Oops, it's just jumped there. It's hit a 3-month low, so that's not good at all. And if we go and look at Asian stocks in here overnight, a significant sell-off in the Hang Seng, the China reflecting stock index down 3%. The Nikkei, the Japanese stock index, was down 1.7. European stock indices lower this morning, between 1 and nearly 2% on the CAC. The French CAC nearly 2%. The DAX down 1.15. The FTSE over 1%, 1 1/3. The UK stock index. And that means then in here, having dipped lower, not showing the dips that we had, but only slightly lower yesterday for the US stock indices. We're down between 0.4 and 0.5 in here this morning for the major US stock indices. Quick nod to the Fed Watch tool. So we're up now. This continues to creep higher at nearly 89% now. Pretty much nailed on for a hike at the end of the month. And if we jump to December now, this is 54% though, staying just one hike, not going any higher. But we are seeing over here, we're at 33% of going higher, and only about 12-13% that we are lower. And if we look in the interim September, pretty much aiming just to stay put at one hike. The market is looking for, I would more likely say hoping for only one hike. There's actually more chance in here of a hike. What's this? 32, say, plus 4, 36% in here in November, compared to, it's more chance of we hike. So the market's almost pricing in a hike and a cut November through December, bizarrely, which is a bit weird. Okay. I just want to show you the yield chart in here. Yields in here. This is a 10-year yield. It broke higher yesterday significantly. We were at the top end of this range, poking the top end of this range. It's been in. So now it's its highest points in all the way over here since March. Okay. So at the high points since March, and this big higher yield move in here was on the banking crisis, right? So we're up to like banking crisis levels in here, not because of any crisis, but because of a more hawkish tone coming out of the Fed. So we broke out of the top side in here on US 10-year yields. And if I just quickly run through the bond charts in here, this is the 30-year. It hit the lows yesterday and lower still this morning. Lower in price, remember, equals higher in yield. 10 years in here, the 10-year breaking down yesterday and lower again this morning, nearly down to these lows on price in March. This is the 10-year future on the September contract. 5-year as well, breaking lower yesterday, lower again today. 2-year as well. So it's right across the curve, a nudge lower and then breaking lower this morning. So lower across the curve in here on the treasuries. That's higher yields. And if you go and look while I'm on the tab in here on gold slightly lower and then rebounding in here today. So it's actually trying to rebound. Maybe as we go into slightly risk off mode, it's rebounding, even though those lower treasury yields in here, higher treasury yields in here should be supportive of the dollar, but we're actually seeing the dollar down in here this morning. So this is really dollar down, gold up. This is the dollar index. Quickly jumping onto oil in here. Oil stays bid. We said, it's fairly firm, rebounding in here since the supply cuts were announced early this week, post OPEC plus now, and sitting close to the recent peaks up here. That recent peak is up at 72.72, so could certainly attack that peak and maybe as high as into the mid 73s going into today. So oil stays firm, and we've got that in the report. Let's have a quick nod onto the stock indices. So despite the setback in here, we noted in here the important level yesterday. Here's the S&P. So we kind of just broken. We sort of sat and held at that important level. Do you remember we identified this tomorrow? Both the 50% of Friday's activity and the 23.6% of the whole move up. We held that yesterday, but then sold off and broken that into late trading and overnight. Okay, but not really a massive breach. I would say whilst now holding above here, which is like around 44.60.59. This is the 38.2% of Friday's Marabouzo. I would say it looks fairly positive still. I'm still looking for a rebound in here, and the market you can see trying to rebound, but it's very going to be much today on the data. Okay, on the data points that we have, pretty much in about 30 minutes now, less than 30 minutes, and then also again just after that with the 10 a.m. PMI data. So we have that on the S&P. Nasdaq looking a little bit more wobbly. First of all, on the daily, we had that setback and rebound in here. Actually, not looking that much more wobbly. Actually, holding on to this kind of area of support. So we kind of dipped just below this area. Actually, just still holding this whole area in here. It really runs from like 280 down to 240. This 280 to 240 area, and it held bang on this 23.6% level at 263. So we kind of held there twice, and it's held again. So Nasdaq's holding in despite the higher yields, which should be weighing on the Nasdaq. It's actually holding in. I'd probably be watching this like little downtrend, this little counter trend line in here that we have running across here. You can see the market flirting with that at the moment. So yeah, looking like it's trying to build a little base in here. So I'm looking for maybe hanging on to the upside pressures in here for Nasdaq and for the S&P. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you tomorrow before the US employment report to see what we've had from the data today and run through the expectations for tomorrow. Until then, have a great trading day. Bye.